Good morning. Welcome to the i3 Equities webinar, co-hosted with PineBridge Investments, on the timely topic of China. And borrowing a leaf from the late Donald Rumsfeld, how China is a known unknown in the equities portfolio. I'm Tech 10 with i3, and I'm pleased to have Anik Sen, Global Head of Equities, and Rob Hinchliffe, Portfolio Manager, and Head of Global Sector Cluster Research at PineBridge Investments, join us today. Anik leads PineBridge Investments' equities business, overseeing fundamental and quantitative strategies that are highly active, while Rob serves as Portfolio Manager for the Global Focus Strategy. He's also responsible for bringing together the firm's worldwide research across the global industries. Now, to just set the context for today, I think it's fair to say that China is an integral part of our growth portfolio, directly or indirectly. Now, we've seen all the numbers highlighting the growth of the Chinese economy, GDP, demographics, trading, and so on and so forth. It's big, it's getting bigger. I think it's a given. But the purpose of today's webinar, it's not to justify why you need to have the exposure to China. I think that case was made some time ago. But instead, let's spend our time today, I'd say more productively, focusing on what it means to continue to be invested in China, given the raft of changes that we've seen in the policy environment, in government. And how do you then size your China exposure? So broadly speaking, we'll cover today's session in three broad parts, three areas. Firstly, the big picture, so addressing concerns about the policy reforms, if you like, confusions about the regulatory intervention that we've seen recently, and then trying to distill them into a risk management and investment strategy framework. Secondly, on portfolio construction, which will likely spend a bit more time here, I guess the inclusion of China in the various global indices, enhanced benchmarks, imply that global investors are inevitably compelled, maybe that's too strong a word, to increase your exposure. Can you deviate from that? And what does diversification look like? Again, here in Australia, we've got the performance test with Your Future, Your Super, where with the benchmark, there are obviously exposures to China there. Again, how do you manage given the risk and concern that we might have? And then last but not least, on ESG and sustainability, where governance is often cited as a key concern. On the flip side, there are potential opportunities in the so-called new China, and we'll cover a bit of that as well. So in terms of format, this will be a fireside chat between myself and Anik and Rob for a total of 40 minutes. I'll encourage you, the audience, to submit questions via the question box, and we'll endeavor to answer them in the course of the conversation. This webinar is for educational purposes only. It does not constitute financial advice. It is intended for wholesale and institutional investors only. So to kick off, let's start by clearing the air about the cascade of new regulations impacting a wide range of sectors, from fintech to property to private tuition. So Anik, I might come to you. With the economy, the Chinese economy, largely market-driven over the last 4 decades or so, these changes were perceived as a retrograde move by the government. Is that correct?
First of all, thank you very much, Tech, for co-hosting with us, and thank you for the introduction. We're obviously delighted to be here. The title of this webinar, I think, is also very pertinent, the known unknown, as you referred to. As you said in your introduction, China is here, China is big, China is a big global growth driver in the world. And whether you're an investor in China or you're an investor in, call it some other part of the world, US, mid-cap stocks, I think China is front and center of our attention these days. We need to know about what is happening in China because of its direct and indirect impacts around the world. Roughly speaking, 25% of S&P 500 companies' earnings and revenues are coming from outside the US. There is a big circular loop, a feedback loop that comes into the US economy. Thinking about the reforms that you asked about, Tech, this is the continuation of things that have been happening in China well before the current spate and the hiatus of activity that we've had. it's not a retrograde it's not a retrograde step, as you question. I think this is, the way I would liken it is that China has become a major global economy, but a lot of its institutions haven't kept pace with the development of that economy. And the known unknown is basically that, China being still in that sort of process of developing, doesn't have the framework of consultative approaches to the marketplace. So when it decides to do something, it suddenly comes out and the markets get surprised. So that's a sort of risk factor that you have to think about. The big word, of course, is that, whether, China's approach towards common prosperity is going back to the bad old days of central, planning. It's about government and state-owned ownership. We think the market is completely wrong in thinking about that. It is almost the opposite. China is not interested in welfarism. China is not interested in even a French-style egalite or an egalitarianism. China is more interested in having an economy with some very ambitious targets. They're looking at doubling GDP by 2035. That's like a 5 to 6% per annum growth. So it's not really kind of, putting their backs to the private sector. The private sector accounts for almost 80% of job creation, 70% of innovation. So it's more about putting in the natural frameworks that we in the West have taken for granted for many years, for decades. But China is now kind of matching its economic size, its impact on the world with institutions, that have been well formed in other parts of the world.
And just to add to that too, I think they're not doing this to slow the economy down by any stretch. I think, if anything, this makes it, it'll help to make the markets function better than they have been. As the regulation matures, the markets can mature too. The standard of living can go up as the safety nets are in place for the population. And ultimately, I think these are good moves that happen suddenly in China and surprise people. But over the long term, they're good moves, making the Chinese market more similar to the other markets around the world.
I take it that you guys are not surprised by the move in that sense. I think if I could ask you to clarify, and you mentioned that there's a couple of words that's been thrown around, acronyms if you like. You mentioned common prosperity. Now, you recently, I think, co-authored a research on what you call the difficulties of the three mountains. And I think, as I understand, the three mountains, you've got healthcare, you've got housing, and education. Can you elaborate a bit more about that research and the difficulties and how that's tied to that notion of common prosperity that you brought up earlier?
Well, if you think about, the Chinese economy, China has achieved what no other, economy in modern times has achieved in terms of bringing so many people out of poverty. And the concept of common prosperity is not a new concept. It's been around in China, for a while now, in their past plenums and in their past sort of, 5-year planning stages. I think what's happening now under Chairman Xi is to get a practical impetus. We have the latest consensus reading in China, and I think the gap in terms of equality, the income equality gaps, has obviously been quite stark, and in fact it's become wider. But that's not just the China phenomenon. I think you see that pretty much all around the world. I think the issue is that as China looks to the next, many years, half the population in China is still, barely $100, per month sort of income levels, and half the population is, of course, driving the economy forward. One of the key ambitions that China has is to, double the income, per capita, or the GDP per capita, between now and 2025. And so, with these ambitions, the idea is that half the population, which is still, not really kind of receiving the social structures, the social safety nets, the unemployment insurance benefits, government is there to provide kind of support mechanisms. And so when they talk about common prosperity, it is really about government's position to provide those safety nets that we have had for many years in developed economies. So I think this is a journey that China is on in terms of developing its institutions, in terms of being relevant to the entire population, and at the same time to have the right regulatory framework where the excesses that China clearly has had are stamped out in terms of unfair pricing, unfair competition, abusive market practices. I sort of said that, look, ESG is bandied about quite a bit these days, but if you think about the three mountains, it is nothing but ESG. It is about having a social dimension. It is about, caring about the ecology. And a lot of the things that China is doing right now, we recognize as very sensible, corporate regulatory frameworks that China has badly needed. We can definitely talk about some of the lessons that China has learned in terms of shadow banking reform and why that was so important. We can definitely talk about some of the issues around the educational companies and why that was important in terms of, putting out some bad practices that were clearly developing.
Rob, anything to add on that?
No, I think that covers it. I think ultimately it's about putting in the safety nets to help the economy function better for everybody. I think that's the goal of what they're trying to do. And if you look at some of the, those three mountains, education, for instance, their education can be very expensive if you want to achieve an education that many people see as a minimum. Expensive tutoring, separate schools, those sorts of things that aren't available to everybody. So what China's trying to do is make the economy work better for everybody. I think that's ultimately what they're trying to do, which gets back to the ESG that Anik just spoke about.
I remember reading.
Sorry to interrupt, but one of the common sort of misperception is that it's about income redistribution, because there's been some talk about property taxes in China. We think that China is very far away from those notions of income redistribution. We leave that to the French economy. That's an aside. But if you look at the tax take in China, there's only about, I think, between 5 and 7% actually comes from personal income taxes. China is still an economy that is very much driven by value-added tax, VAT, and by corporate taxes. So one of the things they're actually looking for is to move away from the property sales-driven taxation system that they've had for raising local financing to very gradually using property taxes as a way of redistributing or rejigging that tax take pie. But this is really not about income redistribution at all. It is really about raising the living conditions and standards, creating more middle-income populations. And to Rob's point earlier on, why is this so important for equity markets and indeed for risk markets around the world, is that it creates a much bigger domestic economy, which is less dependent on the cyclical export-driven economy that China has so far relied on. And so with that comes an economy which is, we think, a higher multiple sort of investment than the cyclicality that China has experienced in the past.
Sure. So what I'm hearing from both of you now is, look, at the end of the day, when you talk regulations, reforms, and so on, what China is doing is probably not a lot different from what the West is doing. I guess the destination is the same. Maybe it's the journey, which at this stage now it's fairly volatile. I guess that leads to my next question, which again is covered in a topic about the known unknown. So we, I guess, try to understand what the government is trying to do. You talk about social equality, about environmental sustainability, and so on. But there's the unknown bit, as in government policy, and in itself is a risk there. You know where they're going, but in the meantime, how is that going to change? So if I can translate that to an investor's perspective, So how can investors mitigate this so-called China policy risk? Granted, again, it's a known unknown there. In the same way as perhaps all the other risks that could be considered as unremunerated. How do you approach that within the portfolio?
Yeah, we manage alpha funds at PineBridge, and we seek to outperform relative to the benchmark. So we know we can measure these risks within the benchmark, and so we know where our investment position is relative to the risk that our peers maybe are taking or the benchmarks are taking. That's how we can measure it. Like any other risk that is very hard to quantify. It's very hard to know where the oil price is going. It's very hard to know where the copper price is going. It's very hard to know where currencies are going. And to your point, it's very hard to know where China policy risk is going in the near term. We know the destination, but to your point, in the near term. So we position ourselves to be investment style neutral, and we also look at a number of risks, China being one of them, to know how big it is, and then we know how much risk we want to take in the portfolio. We choose generally to take advantage of these opportunities when the governments do these things. It creates fantastic investment opportunities in companies that are going to grow for the long term, because again, to your point, we know what the destination is. We know what China's general policies are of bringing back localizing technology or advancing healthcare, improving that middle class, to Anik's point, making that middle class bigger, digitizing commerce. All these things are fantastic investment opportunities. These moves create these opportunities for us to invest at attractive prices. But we need to be cognizant of the risk that China presents itself in the benchmark, and then size our risk accordingly in the portfolio so that we're not taking on more risk than we want to. The exact same thing goes for commodity risks and currency risks. We measure our risks, our credit risk. So we think of it just as the same of those. In fact, back at the start of the coronavirus, we had we looked at what our COVID risk was. Companies that are exposed to coronavirus, hotels, restaurants, airlines, those sorts of things. And what's our exposure relative to the benchmark? That's how we think about it. That's one of the known unknowns.
Tech, to add on to that, what Rob just mentioned, the thing that I kind of say half jokingly is that China is a fantastic student. And the reason that's important is because China doesn't have the long history that, let's say, the US or European economies have gone through in terms of developing their systems, they're developing their institutions. And I think what China has done is to analyze and taken the best of the best, So if you look at their latest, privacy laws, it's or the data security laws, it's kind of fashioned on the European GDPR. In fact, China has almost leapfrogged Europe in terms of some of the algorithm-based decision-making that goes on in advanced technology platforms. And while the Europeans are giving, the member states in Europe a 2-year or at least a 1-year time frame to adjust, when China makes a change, it makes it immediately, right? Now, to Rob's point, one of the things that we look at, and we say that, look, if you have a pretty good grounding of where laws and regulations and how they work in Europe or in the US, it's a very good background to have in understanding what China is trying to do. So when we evaluate any company in China, we put every stock through a research framework that we called ERA. It's Equity Risk Assessment. And that contains 77 data points. And those 77 data points go through things like the quality of governance, the nature of business sustainability, and the amount of financial strength that company has to meet its objectives. And so, when you look at a Chinese company, one of the things that we struggle with is the VIE structure, for example, the variable interest equity structure. And the VIE structure is one of those known unknowns where the market has really worried about the sustainability of that structure. Now, there are some, world-class companies today that are operating under this VIE structure, and yet, there are question marks, surrounding whether this is going to persist or not in the medium term. We don't know. It may not. But we do know that in the short term, it's unlikely to be a serious risk because there's, trillions of dollars of capital that is underneath the structure, right? So the question then for us when we construct a portfolio like that is to say, look, you don't want to be overweighted a VIE structure in your portfolio. So when we look at the companies we want to own, those companies have all been through our filter, the ERE filter. So we like the management, we like the continuity or the sustainability of the business. We like what the company is doing. We certainly, have a high score across the dimensions of the 77 factors, but we structure it so that we are either net neutral or net short or underweight, that VIE risk. Does that sort of give a context?
Sure. And again, I think, Rob, a couple of points which I wanted to take it further. Your points around technology sector and thematics. Now, I know you guys are fundamental bottom-up stock pickers, but thematics, I think, does play a role here. Before we do that deep dive, if I can go back higher again, because I'd like to cover the economics of, and I need to your point about some of the near-term issues. You can't talk China in isolation without talking about the US. And on this, looking at what the Fed is thinking of, I think it's good to get a glimpse of what the Federal Reserve's policy are like nowadays. I mean, we hear about the interest rate liftoff. Can you get your thoughts on that overview on, what's the impact of Fed policies on China, the growth outlook? Is it slowing down? What are the near-term issues as far as that area is concerned?
Sure, I can kick it off, or Rob, if you'd like to go.
Go ahead.
So look, the market has obviously, during the course of this year has been, rather concerned about quantitative tightening, right? And then finally the liftoff, which was from an interest rate perspective, which is expected to be around June of this year. I think when Chairman Powell came out with, his statement just the other day, I think the market was largely expecting, this kind of 15 billion reduction, per month. And, I think the messaging, from a Fed standpoint has been extremely transparent. Now, obviously the US is a rate setter for the world. And, when emerging markets, including China, when they look at their own interest rates, they will look at a real differential between their local rates and the US dollar, rate environment. So what the Fed does is obviously critically important for emerging market currencies, including, those parts of China that are obviously very sensitive. Now, why this is very important for China is obviously that China has always followed a somewhat counter-cyclical approach, if I can call it that, in terms of its policy setting. So if you remember back in 2018, when China started tightening it was almost like an egregious use of shadow banking assets that the Chinese banks had got into, when 30% of all of their activity, their balance sheet, was off balance sheet. It was loosely regulated. There was very little capital, and it was really kind of crying out for better regulation. And China was doing that at a time when the global economy was doing reasonably well. So what you have in the US right now is extraordinary set of circumstances. You have a housing market, which is, I don't know, the Case-Shiller data recently was like, double-digit growth year on year. You have nominal GDP growth expected in fourth quarter of something like 9 or 10%, and in the context of almost zero interest rates. So these are conditions that I think will give a lot of comfort to the Chinese economy in terms of the export-driven, growth buffer that China is likely to have. And it's a great time to start weaning the economy off a very interest rates sensitive sector like property. And so what China has done is they called it the 3 red lines, and they said, look, highly levered companies that really depend on state-owned banks to provide them with the liquidity. You know, Evergrande had negative cash flow since 2015. And so it was a time to start putting that house in order and to rebalance the economy away from property into a broader set of financial assets as a home or as a store of value. So this is why I think the countercyclicality idea is important. Why now? And of course, you know, the longer term aspirations of a more balanced economy rather than being narrowly driven and dependent on property. Rob, do you have some comments to add?
Yeah, you know, this really gets back to how we invest too, because you started out, Tech, by talking about how China's place in the world, it's already set. We all know that we need to invest in China, and that's already a given. And it's absolutely true. And what you can see here, just taking Onyx's point, is how China's looking at the US or the global economy to help decide when they should be making adjustments to their economy and regulations. The Fed is looking at China to know how to set its own policy. And from an investment standpoint, the way we invest is we can invest in China from so many different angles because China touches so many different angles. And that can be through US companies or European companies or Chinese companies. It doesn't really matter. You don't need to invest in Chinese companies to invest in China. There are so many different ways to do it. And it speaks to how we invest, again, relative to the benchmark and how we can be diversified in how we construct the portfolio and the companies we invest in, but at the same time, minimize risk and deliver performance that has volatility very similar to the benchmark, minimal investment style exposure at all, investments that look very different from the benchmark, yet still be invested in China, be invested in these very powerful tailwinds around the world, and consistently deliver alpha, even in this crazy world that we've seen over the last couple of years, regardless of the market conditions. So if we can identify the risks, take those out of the portfolio, and invest in what we want to invest in, you know, that really speaks to how our process works.
Rob, I'd like to labor a bit on this, and I know, Anik, you have points that. So I guess the question, look, we know sort of where China is going in the longer term. Hard to say, but generally speaking, in the short term, there are these issues, and you know we've covered that, policy, regulation, and so on. The indices have increased exposure, China, the various FTSE and MSCI. So from an investor's perspective, you know, can you still have sufficient China exposure, but yet deviate away from the benchmark? Or I guess, Rob, to your point, you know, how can we have a differentiated approach to owning the benchmark?
Yeah, absolutely. It goes right to our process, and we call it life cycle categorization research. And you know, our peers minimize risk by owning more stocks and owning stocks that are very similar to the benchmark. And from our perspective, all that's doing is reducing your potential alpha and replicating the risks that are already in the benchmark, many of which we absolutely don't want to take. In fact, we go out of our way to minimize those risks. So what we do is we construct our portfolios to look very similar to the benchmark from an investment style perspective. Our cyclicality and maturity are very similar to the benchmarks, but they're very different. Our portfolios are very different in every other way. Again, we own most of our portfolios, they're 40 or 50 stock portfolios, 100% bottom up. And what we're looking to do is take the risks we want and minimize all the others. So we can clearly invest in China. In fact, our exposure to China is very similar, maybe a little bit underweight right now, but very similar to the benchmark, even though our exposure to companies listed in China is actually quite low right now. But we have companies, healthcare companies that are listed in Europe that have 30 or 40% of the revenue coming from China. But interestingly enough, thinking of healthcare, we've invested in a healthcare company, a Chinese healthcare company that has 40% of its revenue coming from the United States. So it's a very interconnected world. If you just invest based on where a company's listed, or say I have X% in China and X% in Europe and X% in the US, it doesn't really tell you much of anything. You really need to dig in, look where the revenues come from, look where the profits come from, and compare that to the benchmark. That's how you tell what your exposures are.
Mm-hmm. And I think you had previously, I think I read something you wrote about, there's a difference between risk diversification and risk replication. Now, this is beyond a play of words. What do you mean by that?
No, I think Rob actually touched upon it. I mean, the problem that you have is, in active management or so-called active management, the thing that keeps portfolio managers awake at night is when you have, let's say, a benchmark name that is 200 or 300 basis points off that benchmark, moving by a lot, and the strategy or the fund has no exposure to it, right? So let's assume, one of the top 10 names in the benchmark goes up by 10%. I mean, that is enough to destroy the performance for the whole year for a fund like that. So what happens is that, a large institution, typically, let's say in global equities or in regional equities, they will have 2 or 3 providers of a strategy. And the intent behind, having more than one is to have manager diversification, but primarily to have some alpha diversification as well, because it's not about having the same sort of idea replicated across multiple managers. But the problem you face is that even if you take 2 or 3 funds, they tend to have very similar holdings, or they're driven, the top 10, top 15, top 20 names tend to be very similar. So instead of getting diversification, you get risk replication. So they tend to move all at the same time. So just take the most recent debacle around education stocks. We had 0 exposure to education stocks because some of those concerns that China as a government expressed, you could see we have very minimal exposure to property sectors because, again, some of those leverage concerns are very, very visible. We have very minimal, in fact, almost, in the global focus strategy, we have 0 exposure to, Chinese banks because they're connected with the property sector. So if they have to take some haircuts, it's obviously going to be taken by some of the banks. So the issue is that, when you choose managers, you really need to kind of look at the holdings and you need to see how you get risk diversification, which is really not present in the industry today. So the natural tendency, I think, in the asset management industry is to head towards that commoditization of the industry. And that's why the battle is really on fees and the battle is about size. So, what we seek to bring is that diversification without additional risk. And as Rob mentioned, that comment, without additional risk, is so important because if you can structure portfolios and be style neutral and core, you can have alpha with a tracking error, which is relatively modest, 300, 400 basis points sort of tracking error, yet have an active share, which is above 90%. And the way you kind of do that is basically by taking one of those big heavyweight stocks and understanding the factor drivers of that company and expressing those factor drivers in a better company, which is smaller, where your return on investment is potentially 2 or 3 times higher for the same degree of upside, because you're expending so much capital to express the same active position in a big heavyweight stock versus a stock with a lower benchmark weighting. So we think it actually serves a multiple purpose, but the main purpose that we would serve is that you're controlling a risk, but you're providing a much, much higher ROI.
Ani, if I could continue on that argument there and picking up Rob's point from earlier. So you say, look, you've avoided education and tuition, property companies, banks. Rob, earlier on you mentioned about the potential for sort of healthcare companies, and that's probably quite obvious as well. Can we get into the technology sector? Now, we know that there are opportunities there, innovation and so on moving forward, yet we have seen how some of these fintech, again, depending on how you define what's fintech and technology, have been affected by regulation. So what's the approach towards sort of the technology sector?
Yeah, so technology, I mean, technology is such a big, broad sector. There are some clear things that I think we know that are going on. China's looking to bring home, localize a lot of their high-tech manufacturing, trying to move up the value curve that, other parts of the world have. And so that's more where we are invested. Some of the fintech areas, when you dig in and you run those through our ERA process that we talked about before, they throw up some red flags from our perspective where we debate the sustainability of them. But when you get into manufacturing, some of the digitalization of the factories, some advanced sensors and manufacturing, that's an area where we think there's a long runway. And you can invest in that directly through China, but the supply chains are long too. So you can invest in that through other companies around the world that have maybe indirect but very, very tied to what happens in China. So again, there's a variety of ways to invest in the tailwinds in China beyond just Chinese names themselves.
Yeah, I guess it's often it's tricky, and you don't know where government regulations is moving more in the shorter term, and what it means for the various areas. And so I guess as far as technology is concerned, a pretty nuanced and sort of granular approach probably justifies that.
I was just going to add, you mentioned fintech, so financial technology is extremely advanced in China. If you look at, one of the, major e-commerce players that we all know about, that has financial technology prowess, which is, I think, unmatched by the big, card payments platforms, for example, in the West. So the technology is definitely there. The problem, I think, where this particular platform got into is about monopolistic behavior. It's about something that we take for granted, particularly here in the US. It's called loss retention ratios. So when you raise a loan and when you sell a loan, there are certain rules around loss retention. They were clearly not doing any of that. And what is interesting is that governance failure was something that was actually flashing red to us.
Right.
And it's one of those reasons why we actually avoided this company. So I think fintech is an area where I think most governments are looking at further innovation. It's not that China wants to put a curb on it, but what China is doing is to curb some of these bad practices that this particular company, and there are one or two others that we know of, are actually pursuing right now. On the same vein, China was operating one of the biggest P2P lending businesses not very long ago. And, it was actually in the, over $1 trillion of assets in the P2P lending business. That disappeared, because the sort of companies that were actually promoting P2P and the risk that people were facing in terms of their savings was extremely substantial. So it's still an area that we do not credit very, very well, very, very gingerly. And we know this because, half our team in PineBridge is actually based in Hong Kong, in the region in Asia, as well as our exposure to mainland China with our joint venture partner, Watai PineBridge in Shanghai itself. So there's a lot of body of on-the-ground information that I think you need in order to be an investor, not just in China, but I would say globally.
Sure. There's a question from the audience here, and I thought I had we've covered geopolitics in other sessions and didn't really cover that, but this I guess points to that. So if China wants to bring technology development to its local economy, how attractive is Taiwan? And how likely is it that this will lead to serious conflict?
Do you want to take that, Rob? I can follow. I can follow up.
I mean, the honest answer is I don't know. That's above my pay grade if this is going to lead to serious conflict. But I do know, I do get back to how interconnected everything is.
Sure.
And what that means is, we mentioned VIEs before, we've heard about repatriating money, we've heard about trade, and at least from an investment standpoint, it doesn't seem like one country can do to another without it impacting the investments for all markets. Again, China is a huge economy. It's the lion's share of global growth. If China slows down, that impacts global markets, and vice versa. If they do something to the US, it's the biggest economy, and that impacts global markets. That gets back to the interconnectedness of the central banks and things we talked about before. So I don't know what's going to happen with Taiwan, but I do know that the markets are interconnected, and it wouldn't be an isolated event by any stretch.
Taiwan is obviously a very important component in supply chains around the world. And that is why we actually have a team based in Taipei, so that we get, on the ground information for our global teams around the world. Relatively few asset managers actually bother to have people in Taipei. We actually have a pretty large office in Taipei, so we get real-time information coming from that particular island. Now, of course, the history of Taiwan goes back decades, and I think there is a different political agenda that I think the Chinese government has been very clear about. But from a technology standpoint, China has a lot of the technology that I think, except for one company, but China is trying to catch up to that one company. But I think Chinese technology is probably, already beyond, some of the capabilities of the technology that Taiwan does. Taiwanese technology, apart from this one company, tends to be somewhat lower end, more of a supply chain type of technology. I think what China is developing is an equivalency in terms of chip design with some of the best companies in the US. They are developing equivalency in terms of, certainly automation, where China today is, I think, leading in a variety of fields. And of course, China is doing tremendously well when it comes to, the sort of greening, if you like. The eco aspect of Chinese policy is a very important development. And of course, in areas like space technology, China is already kind of on par, I would say, with some of the best technology that exists around the world. The word that we use internally is global China or global Asia. One of the benefits that China has, let's say, relative to a country like India, is that it has low cost of capital, and it has the ability to scale up very rapidly. And of course, it has some of the incentives that the government does provide in order to scale up rapidly. So, you're seeing the emergence of companies with global scale. Like Rob mentioned earlier on, in a company that we own, 40% of its business is actually outside of China right now. So, it's that sort of competitive area that China is now exploiting. The one thing that I would caution, though, is that China is still very dependent on some US and European companies in terms of key technologies. And it's one of the reasons why we think you have some of these shortages that have developed in the chip space. And so, there has to be a race, I think, as the world moves into 5G, if the next area of geopolitical tensions is to withhold some of that technology that the US companies in particular provide China, you could see some areas of potential concerns. We are very cognizant of that as another risk factor. It's another one of those known unknowns, if you will, within the spectrum of risks that we have in portfolios.
Thank you. I think we've covered. I think we've run out of time, but we've covered lots of ground here. I was just going to add that I think often when we think about technology and geopolitics, I guess the whole semiconductor discussion tends to dominate, and probably too much as well. But there are other sub issues, within China, whether it's the the localization theme, I think I recall other discussions say, you could potentially be looking at the next Texas Instrument or the Qualcomm of China, and many other possibilities there beyond, I guess, semiconductor, that discussion. So on that note, look, thank you very much, Anik and Rob. This has been fascinating. We could go on for a longer time, but hopefully, again, with the changes, and we've covered enough of the known unknowns, policy risk, regulatory risk, but yet in the long term, hopefully, the audience will have a sense of the journey that China is traveling. So on that note, thank you to both Anik and Rob. To our audience, I hope this has been meaningful. For now, stay well, be safe, and hopefully see all of you in person sometime soon. Bye for now.
Thank you. Very welcome.
Thank you.